Okay, let's get you some important macro update. India's GDP grew at 6.3% in the second quarter. This is largely in line with the CNBC-TV18 poll, which had predicted a growth of 6.4%. But it is much slower than the growth seen in the same quarter last year. Lata is here with the details. Lata?
Yes, in line with what even the Reserve Bank forecast at 6.3, but the GVA, gross value added, has grown by only 5.6%. GVA plus taxes minus subsidies gives you GDP. So it looks like a very good GST collection has made for good GDP. Perhaps the underlying economy is not as good as the 6.3 is indicating. Agriculture is clearly the best sector. 4.3%, much better than what anyone expected, but it's countered by manufacturing, which is contracted 4.3%. Contraction or flat was expected because, all those chip shortages, logistical problems starting with China and elsewhere, but not really minus 4.3. Made up for to some extent by services, where trade, hotels, transport and communication, the biggest employer in the whole GDP sector breakup, has grown by 14.7%. Now, let's not get carried away. If you looked at the actual output, it is 6.5 lakh crore that has come from this segment. Exactly the same amount was the output it generated in 2019, which means it's not really grown in 4 years, deeply hurt by COVID. You'd keep that on board. The other important point is, on the other side, positive, private final consumption expenditure, excellent, grown by almost 10%, 9.7 to be precise, and capital goods grown by 10.5%, 10.4 to be precise. So consumption and capital goods firing, very good news. Government expenditure, disappointing, minus 4.3. That's a bit of a surprise, but possibly will get better because states will start spending in the second half. What does all this mean for the state stock markets? I would think, let me just concentrate on this exports. That's also a drag on the expenditure side. Imports are far higher than exports. So the net export drag from the GDP is double what it was last year, same time. What this probably means is that our consumption is very good, but we are consuming more imports. And that perhaps is a pain point, something for policymakers. Also, consumption being strong, but trade, hotels being weak means that consumer discretionaries are clearly stronger than what consumer staples could be. The demand is on that side. Just a last word, CEA, the chief economic advisor, said that GDP should be 6.8 to 7%. Looks like everybody is reconciled to GDP not hitting 7% this year.
Very comprehensive, Radha. Thanks very much for that. Actually, let's listen to the chief economic advisor, Anantha Nageswaran, who had and what he had to say after the GDP numbers were announced.
Overall, real GDP growth in 22-23 is on track to be at the range of between 6.8 to 7%, and IMF maintains 6.8, RBI maintains 7%. And I think the more important thing is, if you look at the festival sales, if you look at the bank credit growth, if you look at the purchasing managers indices, whether it is services or manufacturing or the composite outlook, the economy has maintained its momentum, especially, I reiterate, in the face of very strong global headwinds and uncertainties.
All right, that's GDP here.